Morning, everybody. Ready to continue with our model, and we're in the middle of the depreciation schedule. If you recall, last Monday, we had modeled out our straight line depreciation. And I want to address one thing. Somebody asked a very good question online, but I want to address, and I kind of struggled with. This kind of person hit right on the head with what I was thinking through. If you notice where we ended up with our property, plant, and equipment is we ended up with an implied depreciation rate of 3 years. Now, remember what we're doing here. We're trying to figure out, somebody asked, can I get a weighted average? And I said, yeah, you can kind of do that. And we spoke about that last class. In order to figure out what the actual depreciation life is, the struggle is we found a table which is often produced where the company talks about how they calculate straight line depreciation, and they say they use a useful life of anywhere from 3 to 40 years. And that range really depends on the type of asset that they're purchasing. If they're purchasing a big warehouse building, it's 40 years. If they're purchasing, let's say laptop computers, that might be 3 years. So how do we apply what we know as $72 billion to one number? Because we need to kind of step back and think about one simple number for our projections. So I know somebody asked about a weighted average. A weighted average, as I mentioned in the last class, isn't completely accurate because really you don't know when this equipment was purchased. You don't know how long it's been depreciating for. This 72 billion is a net number. This is a net number after past depreciation. So the weighted average would work if we applied it to the purchase price, the actual purchase price, the original value of the asset, not the value of the asset that's already been depreciating. And if we applied it way back to the beginning at the time that it was purchased. So in other words, you can never really get a complete picture of depreciation unless you've built the schedule calculating every single asset from the beginning of its purchase date and the value that it was purchased. So this method that we're using to get to that we got to the number of 3 is really an implied weighted average, but that includes the concept of the fact that these assets have been depreciating, and we're calculating this 3 years not off what would be $200 billion, the purchase price, but the net $72 billion. So in other words, if you looked up and said, well, this property has been depreciating 40 years and you divided this net value by 40, you'd be wrong. That 40 needs to be adjusted down for the fact that it's been depreciating for 10 years already. So all that is why I've gotten to this 3 doesn't literally mean it's depreciating 3 years. It's an implied impression of how many on average years left do we have for this depreciation. Now, what this person asked, which was extremely accurate, is, well, then after year 3, this depreciation should go away. And that's true. But now what happens? We have a significant drop. So we have a flaw in our analysis. Now, in reality, what this means is if this $72 billion will be fully depreciated in a few years, the company needs to start replenishing that. And we don't know how the company is going to replenish that. Usually it's by increasing Capex, but this was our Capex guidance at the time, or by making some sort of massive acquisition. So I struggled with this. I did a lot of research, and what I concluded was, to be completely honest, is I can't give guidance past year 3 at this point in time. What I would have done is have and it sounds like a cop-out, but I would have had a model that ended after year 3. I don't have any guidance on what the company is going to do past year 3. What the company needs to do to fix this situation is either buy a lot of property or increase their Capex. And guess what? As I mentioned, I think I mentioned at the end of the class, there's a little bit of a flaw here, or I mentioned to this student on YouTube, I said, luckily the company had produced guidance last week or the week before already for the next year, and they revealed what they were going to do. And so to not get too overly complicated here. I'm going to leave this the way this is for now. Okay. I know there's a little bit of a flaw here, but we're learning about the mechanics of the modeling. So I want to leave this the way this is for now. But just so you know what the solution is, the solution was we got clarity with their next year's guidance. And what happened was in their next year, in 2021, they did buy a lot of property. Their property went from 72 billion to 113 billion. So they increased about 40%. And their Capex went from 27 billion to 40 billion. So they did a lot of purchasing. And so for the book, what I'm really going to do, and I'll reteach these classes after we finish this valuation. I'm going to go through the whole class again with the next year's guidance. Now, unfortunately, next year's guidance came out last week, so I'm not going to go back and remodel everything. That's just going to cause confusion, right? The purpose of this class is just to teach you the skills to put together any model. But just so you know, the solution gladly was revealed. And the solution was, when I rebuild this model for 2021, it's going to have a lot more property and a lot more Capex, which means this number is not going to be 3, it's going to be 5 or 7. And so we'll be able to fully project out. So I just want to kind of answer that. And so we can kind of move on, closing that loop there. So we've built depreciation. Depreciation was linked into our income statement and now flows into our cash flow. Okay. Now, the next thing I want to talk about that comes from the depreciation schedule is deferred taxes. I want to talk a little bit about deferred taxes. So deferred taxes. So obviously about taxes. Taxes is one of the main purposes of creating the income statement. Your taxes are calculated based on your earnings before taxes, which is almost your bottom line. You can defer taxes under certain conditions. And one of the more common conditions for deferring taxes is by creating a liability, a deferred tax liability. Now, a deferred tax liability is created or based on a timing difference in recognizing income between your GAAP reporting and your tax reporting. So what does that mean? Well, what I didn't mention in the beginning of the class, and now you should know, is you oftentimes produce, or pretty much always, 2 books. When I say 2 books, 2 sets of reports. One is based on the generally accepted accounting principles, the GAAP accounting, which is the reports that you create for your investors. They get reported on your investor relations website. And then you have another set of reports based on different you use much of the same accounting principles, but you can report some line items different for tax purposes. And so oftentimes your financial reports for GAAP for your shareholders might come up with numbers that are slightly different than your reports that are sent to taxes. Why would you want to make reports different? Well, if you have a set of financial reports, let me put it this way. Let's say we have a set of financial reports for our investors, and our purpose is to make sure our profits are high because we want to show to the investors that we are extremely profitable. So as you know, as we learned from the income statement, there are a lot of accounting rules in terms of recognizing revenue, in terms of recognizing costs, that may not really directly lead to the fact that we've actually paid or received those items in cash. There are timing differences, right? We talked about this in the very beginning. You can, let's say this delivery company that we are modeling, how do you record your revenue? Do you record revenue on Amazon as soon as the customer places the order? Do you record revenue on Amazon as soon as the package is dropped off and at the customer's front door? That's a big timing difference. It could take 5 or 7 days. Well, Amazon promises 2 days in many cases, but there's a timing difference between when the customer places the order and when the package is actually on the doorstep. So when do you recognize the revenue? That timing difference could change the way your financials are perceived. And there are some rules that the government has where if you're filing taxes, you have to record it this way. And there are some rules where they say, well, if you're filing financial reports for the investors, they don't have to be recorded that way. They can be recorded this way. So you can produce a set of reports utilizing rules that are slightly different than the tax reports. So it is possible to produce a set of reports for your investors where the net income may appear higher than the net income reported for tax purposes. Why would you want to do that? Well, you are taxed on income. So if you have $10 billion in net income and you believe that's true, and you send that to your investors, and then it's time to file taxes, you might say, well, listen, I'd rather pay as little taxes as possible. So I'm going to take advantage of different tax rules. It's all legitimate. It's all legal. I want to take advantage of different tax rules that might not show $10 billion in net income. Maybe it's going to only show $7 million in net income for tax purposes. Why would I want to do that? Because then I get to pay less taxes. So I'm showing my investors we're very profitable, $10 million. But when it's time to file taxes, I'm showing them a little bit of a lower number. I can save money on taxes. Now, you're not falsifying anything. You're not changing anything purposely, right? Because what's going to happen for the taxes is you're not saying, well, you didn't record $10 billion in net income. You're saying what you're saying to the government is, yeah, you recorded $10 billion, but I'm only going to pay $7 billion on tax of that now. I'm going to pay the $3 billion later. You're deferring your taxes. You're not changing everything. You're just taking advantage of timing differences and deferring your taxes. There's lots of examples where you can adjust your accounting methods in order to pay less taxes, again, in the near term. What you're doing is you're creating a deferred tax liability. So you're not really saying, hey, I only made $7 million when I'm telling my investors I made 10. No. What you're saying to the government is I made $10 million, but based on your principles, I'm going to pay taxes on $7 million now. Next year, I'll pay that remaining 3. Frees up money in the short term. Okay, so I'm going to show you my example. So a couple of examples are doing that is the way you track inventory. There's a common example. Any accountants out there that are listening to this course, I've learned about LIFO and FIFO. You know, how do you record or book your inventory? First in, first out, last in, first out, right? And you can change those methods between GAAP reporting and tax reporting to create advantages that might end up with a deferred tax liability. Simply put, it's the taxes that you owe but did not yet pay. You're able to defer it. So if you owe $1 billion in taxes, and based on adjusting these rules, you only have to pay $500 million, that remaining $500 million you still owe, not until later, it becomes a liability, a deferred tax liability. So the reason why I'm talking about this in depreciation is because one very common way, and more importantly, one very common modeling technique that analysts use and that's often tested on in job interviews is utilizing the ability to change your method of depreciation to create a deferred tax liability. The depreciation line item is one that's very often adjusted between GAAP reporting and tax reporting that could result in a deferred tax liability. Namely, we are using straight line depreciation. A company is allowed in the US to accelerate their depreciation in order to create a deferred tax liability. As we mentioned in the last class, there are many ways to depreciate your property. most commonly for GAAP purposes is straight line. Real simple. Asset has a life of 10 years, take the value of the asset, divide by 10. I also mentioned the idea of accelerating your depreciation. You have the ability to accelerate your depreciation. Accelerating depreciation simply means your property depreciates faster earlier. Really, you have a bigger depreciation expense in the first few years and less of a depreciation expense in the later years. So companies might take advantage of accelerating depreciation for tax purposes only, which means you have a greater expense, which will give you less net income for tax purposes. I know this sounds like a lot, so I've laid it out in an example. Let's look at this example. This goes back to the same income statement we looked at a few classes back, right? This is the small little trucking company. He has 10,000 in revenue here. He has 5,000 in EBITDA. He has 1,500 in depreciation. If you remember, his truck was $20,000. He had a residual value. That difference divided by 20 years was 10 years, sorry, is 1,500 a year, trickling down to 2,100 in net income. And if you remember, his original problem was because he had $2,100 in net income, he thought he'd have $2,100 in cash to fix his repairs on his truck, to make the repairs on his truck to continue to perform his operations. But because of the differences between net income and cash flow, he only had $100. Remember, we pulled out the revenue on credit, $3,500. We added back that $1,500 in depreciation. That gave him $100. Don't look at this $900. This is what we're going to illustrate next. So next, what we're going to illustrate is he's now taking advantage of the ability to change his depreciation method to free up cash. Column on the right is your income for tax purposes. Your income from tax purposes is the same all the way up to EBITDA. Now let's look at depreciation. Oops. He is going to use a common method of accelerating depreciation, which we're going to talk about in a second. One common method to accelerate your depreciation is the modified accelerated cost recovery system. This is called MACRS. This is the most common way to accelerate depreciation in the US. It's simply a table of percentages, and these percentages you apply to your property value. 25% times this value of the truck gave John $3,750. So in other words, by using this accelerated depreciation method, he was able to increase his depreciation expense to $3,750. What does that mean? You have a bigger expense, you have less EBIT, you have less EBT, you have less taxes. So you don't want to, you'd prefer not to show this to your shareholders because you want to show your shareholders a big net income, big profits. But the negative to big profits is big taxes. So you show smaller depreciation expense, bigger profits to your shareholders. To your taxes, bigger expense, less profits, but less taxes. Now you owe those taxes later on. So what happens is, even though you've expensed $1,400 in taxes on your books for your shareholders, you've only paid $500. So that remaining balance, that remaining $1,400 minus 5, that $900, that difference becomes a deferred tax liability. That's an add back because that is an expense that I did not yet pay. Of the $1,400 in taxes expensed, I did not pay $900. I add that back to my cash flow statement. That's why on your cash from operations, it's net income, change in working capital, plus depreciation, plus deferred taxes. That's why. So if we recalculate his cash flow statement now, you have your $2,100 net income minus your $3,500 in revenue on credit, plus depreciation, plus now deferred taxes. Now he has $1,000 to make his repairs on his truck. He has used the method of accelerating depreciation to create a deferred tax asset to free up cash in the short term. Now, what are methods of accelerating depreciation? There's the declining balance, double declining balance. This is often used in Europe and the UK. The double declining balance is very simple. You take the reciprocal of your useful life. In other words, if your useful life is 10 years, you take the reciprocal, 1 divided by 10, 10%, and you double it, 20%. That's your double declining balance. You apply 20% to your asset, double declining balance. In the US, we use modified accelerated cost recovery system, which is a series of percentages that are provided to you by the IRS. I'm going to supply this document to you guys in an email. If you go to irs.gov, or I just simply Googled IRS Modified Accelerated Cost Recovery System, they give you tables. And based on your useful life of the asset, 8 years, 8.5, 9, 10, whatever the useful life of the asset is, you have percentages that you apply. So for our model, if we're using a 3-year life, we depreciate the assets 43% in year 1, 28% in year 2, 25% in year 3. Very simple. We're going to take these percentages and apply it to our property to accelerate depreciation to defer taxes. Now, quick side note, I want to show you how to model it out, but I'm going to show you afterwards. Amazon doesn't do this. But I didn't want to skip over this topic because it's so important and it does come up in interviews. So I want to go through how you apply the modified accelerated cost recovery system schedule to create a deferred tax liability. So we'll model it, but we're not going to actually link it into the cash flow statement because Amazon doesn't do it this way. But I want to show you how it's done. So we go to our model. We go to depreciation. If you scroll underneath the depreciation, you've probably already seen, we have an accelerated depreciation schedule with fake percentages. I want to put in the real percentages. And what you do is, for the existing PP&E, we see, what was its useful life? 3 years? I'm going to first hard code these percentages in. Year 1, 43.75%. Year 2, 28.13%. Year 3, 25%. A little bit in year 4, 3.12, and then 0 going forward. Now, I want to just expand this into its full 2 decimals so you can see what I've done, but I'm going to send you the document. I'm going to send you these percentages so you can match it. I'm now going to go a little quick because this topic isn't really pertaining to the valuation of Amazon, but I want to check the box to make sure you know about this. For Capex, we've used 7 years. Here are the 7-year percentages, 18.75. In year 1, 18.75. I'm going to just copy this down because it's going to give me the formatting, 18.75. Next year, 17.41. Next year, 13.68. Next year, 12.16. Next year, a 12.16 actually comes 4 times, all the way to the end. Okay. Now, let's before I put these percentages in, I want to show you I think this is easier. Let's calculate underneath. There's 2 sections of accelerated depreciation. Here's where we lay down the percentages to apply. And this is where we're going to actually do the calculation to calculate our value. So what the formula is already in there for us, but I'm going to overwrite it so I can show you what we do. So what happens is for existing PP&E, we take the property, 72 billion, and we multiply it by 43.75 because the depreciation in year 1 is 43.75 times that 72. If you notice, these percentages should add up to 100. Why is it 110? Did I make a mistake? 43.75, 28.13, 25. Aha. These percentages should add up to 100. Good sanity check. I caught myself there. Right? 100%. Because you fully depreciated it by then. These percentages won't quite get to 100 because I have 2 more years. So what happens is I apply 43% of the property value in this year. The next year, 28%, and so on. Now, I want to show you something here. If I do a Control R, I'm not going to get what I want. Why? Control R shifts the references to the formula. If you look here, this reference shifted 43% to 28%. That's what I want. But this reference shifted. I don't want this. I want to be able to copy right and have the bottom half of this formula shift, yet the top half of the formula to remain frozen, anchored. How do you anchor half the formula? Well, you only put dollar signs around the half the formula. The formula that I want anchored is the reference to G6. So I'm going to go $G, meaning anchor G. Anchor G only in the top. Don't anchor G on the red. Don't anchor G in 23, because 23 I want to shift to the right, but I want to anchor G. So now when I copy to the right, this is what I get. I get 28% of the property value. There it is. References work. If I go to the right one more time, I get 25%. So you can see what happens here. If you look at the differential between 31 and 24, I've accelerated my depreciation. I have a bigger expense in the early years. That's going to, for tax purposes, show me less taxes, deferred tax asset. But it's going to catch up with me. In order for this to work, in the latter years, I'm going to have a smaller expense, reflecting the fact that I have to pay back those taxes eventually. Let's continue on. For PP&E, I'm going to take my value of PP&E that's come in that year, 2020, times 1875. And again, I need to anchor the reference to that top portion of the formula so that when I copy to the right, that reference doesn't shift, but the reference to the percentages do shift. Okay. Now, in 2021, this is what I want to explain. In 2021, I don't start my depreciation until this column. Sorry. Until this entire column. So I have $27 billion of Capex that's not going to come into 2021. I need to apply, don't apply it to here. That's not right. This Capex will restart its accelerated depreciation from the beginning. You need to apply 1875. That's why we have a different row of percentages for each new Capex to come in. 1875 here, 1741, 13, etc. So what I'm going to do is I'm going to copy this to here, 1875, 1741, 1368. That way I can take 27, anchor it, times 1875. Here, clean, copy that to the right. In the next year, same idea. I have $29 billion in Capex. I'm going to apply to this percentage. Now I got to make sure these percentages are correct, not 25. This is just the template. So I'm going to take 1875 and so on, copy there. That way, I'm going to apply 29 billion anchored times 1875. Copy to the right. Okay, and so on. I'm going to go a little faster, but you're going to have the video. You can follow me slowly. Copy down. Oops. Copy down. Copy down. Copy down. Each flow of Capex gets its own schedule. Anchor. Multiply by new percentage. Copy to the right. Same idea. Anchor. What I'm doing here as a quick anchor, F4. F4 is a quick way to anchor. Remember to anchor only one side of the formula, the reference to the top, not the reference to the bottom. You're not going to get correct numbers that way. Oops. And finally, even though I'm not copying to the right, I'm just going to anchor just for the sake of formula consistency. And I'm going to alt equals, get a sum. And as you can see, what I have here, I have positive depreciation liability. In the future years, though, it's going to be negative. Now, you can see right off the bat why Amazon isn't doing this. Usually, this is unusual. So usually you get a liability for a certain amount of years. Usually what happens is, as you can see, that if the tax depreciation is greater than the book, right, then you have a liability. Then you've saved taxes. And usually in these models, the depreciation is greater than the book for quite a while. In this case, the depreciation is greater than the book only for 1 year. Then they have to pay it back. So this method isn't really benefiting Amazon right now. So I think this is why they're not using this. Well, there's a couple other reasons too, which we'll get into. But I just want to show you the mechanics so you have this in your skill set. But what you would do now is you would take the difference in depreciation, accelerated minus the straight line, copy to the right. As you can see, positive liability quickly becomes negative. And then you multiply by the tax rate to calculate your deferred tax liability. Why does that work? Why is your deferred tax liability your accelerated depreciation minus your straight line times the tax rate? Well, this slide shows it all. If you remember this example, what I've done, what's really happening in here is because of accelerating depreciation, my net income is lower. My taxes are lower. I have $1,250 in EBT. $1,250 times my 40% taxes gives me only $500. I owe $1,400 in taxes, but I'm only going to pay $500. So that difference, that $1,400 minus $500, gives me $900 in deferred tax savings. So now, one way to calculate my deferred taxes is to create two income statements like I've done here. I can build the GAAP income statement, then I can build the tax statement. That's quite monotonous. The other way to look at this, the box illustrates on the right nicely how you can back into the deferred tax savings by taking the difference in depreciation. So here, all I had done was I've taken the $3,750 minus the $1,500. That difference in depreciation is $2,250. That's the actual expenses adjusted. That's the actual difference between my EBITs. My EBITs lower by $2,250. That's where my tax savings is going to be. So I take that difference, I multiply it by 40%. Guess what? That gives me the $900 in deferred taxes. Very importantly, understand this box because common investment banking interview question is, why is it that deferred taxes is calculated by taking your accelerated depreciation minus your straight line depreciation and multiplying by a tax rate? Why is it? A lot of times analysts can't explain that. They've memorized that process, but why? This is why. You're backing into the difference in net income and applying the tax savings to that. So the difference in depreciation, what we're doing here, difference in depreciation, accelerated minus straight line, times the tax rate, gives me deferred taxes. What tax rate? Very important to make sure you're pulling in the exact tax rate that was applied on your income statement in that year. So I'm going to pull in my 2020 taxes, 21%, copy to the right. And as per this table, as per this box, you multiply 2,250 by 40% to get the 900. So 8,593 times 21%, 1,804. Now, it doesn't make sense for Amazon to do this. Why create a liability 1 year and then to have deferred? In the future, and part of the problem is because of the way their property is aggressively declining. Normally what we would do is we would link this into the cash flow statement, but I could even see by the direction and the trends and the value of where the deferred taxes are, they actually had a negative number, they had an asset, and then they're building a liability. It looks like they're trending in a much different direction than the way we've modeled it. They're doing something very different. So what we're going to do is we're just going to go with the simple, we're going to use the 7 methods. Let me see how much time I have in my Zoom. Do I have time to talk about it? Usually a window pops up. All right, we're going to keep going. Usually a window pops up, but let's see what happens. Oops. Here you go. Okay. Oops. Sorry. So I want to show you what I mean by the fact that, let's go to deferred taxes. They talk about their deferred tax. Oops. Deferred tax assets and liabilities. Deferred tax assets and liabilities. There's a table that lays out, which is not uncommon. Here, let's take a look at this really quickly. Deferred income tax balances reflect the effects of temporary differences between carrying amounts of assets and liabilities. This is what we talked about. Timing differences. Now they have a nice table that shows, here you go. Nope, nope, not quite. Not quite. Okay. This is part of it. Current deferred taxes. Talk a little bit more about deferred taxes. Here you go. Here it is. Perfect. Well, this table shows deferred tax assets, how they calculate that. Deferred tax liabilities. Now, a couple things. First of all, you see right off the bat, there's a lot of components that they're using to defer taxes. Here's depreciation and amortization. This is what we spoke about. It's just a very small portion, though. They're using a lot of other methods. Loss carry forwards, right? If you have net income losses early on, you get tax credits. It's another way to defer taxes. Stock-based compensation. So there's a lot of ways to apply stocks and investments to create deferred taxes. So the short answer is just depreciation alone isn't enough to get us to accurately project out the deferred income taxes. And this is why we're getting very different numbers than what they're getting. So I want to illustrate that. Okay, so next week, what I want to do is I want to talk about you just narrowing down the 7 methods to project out deferred income taxes, real simple. Then we have the final biggest hole in our cash flow statement, working capital. So I want to talk about operating working capital, how to model it. So next week, we're really going to focus on modeling operating working capital. We're going to tie working capital back to the cash flow statement. Cash flow statement is going to be pretty much done with the exception of the debt schedule. The debt schedule is the final thing we do in modeling. So we're not going to go there for a little bit. After working capital, we're going to lay out the balance sheet. We're going to model out the balance sheet. Then we're going to build the debt schedule, which is the final schedule. And then we can value our model. Okay? So if you have any questions, let me know. I do respond on YouTube. Please shoot me an email on YouTube. And have a good week, guys. Thank you very much.